Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Brian Joyce, he's managing director on Nasdaq's market intelligence desk. We're going to take a look at a number of charts for you today. Brian, before we get into that, let's talk about today's action real quick. In addition to the tape in the green, 6 IPOs on Nasdaq today.
Yeah, we had 6 IPOs today, so certainly a constructive sign for the capital markets. And what we're seeing in the markets today themselves is a risk-on environment. Equities are higher, oil's higher, and rates are down.
All right, and to no one's surprise, it all comes back to what's happening with the Fed, putting that put in the markets. Let's take a look at our first chart here. Here you're showing us the 5-year forward break-evens. What is the Fed looking at when it sees a chart like this?
So a lot of people are asking, why does the Fed need to cut rates in the first place with stocks at or near all-time highs? One of the main reasons is inflation. The Fed has a dual mandate, employment and inflation. On the second mandate, inflation, it's targeting roughly a 2% inflation environment. What we're seeing right here now is the 5-year forward break even. This is the difference between the inflation securities, TIPS, and regular treasuries, looking at years 6, 7, 8, 9, and 10. So years 6 through 10, they like to look at this measure because it's a less volatile measure as opposed to the 5-year or the 10-year break evens. Right now, this is, as we can see, is breaking down to fresh multi-year lows not seen since, let's say, mid-2016. Not typically what you would see in a strong economic environment, so to speak.
All right, and the Fed's also taking a look at our second chart here. This is a yield curve inversion.
Correct. So typically, a constructive-looking yield curve will have a positive slope to it. Here we have the opposite. We have an inversion. Everything from the 10-year down to the 1-month bill is trading below the overnight Fed funds rate, which is currently right now at 2.36%. So other measures out there in the marketplace, like credit, high-yield credit, they look good. And so what this tells you is why some people may look at this and say, oh, this is a sign of a recession coming down the road. I look at it and I say, what I think is probably going on is the Fed probably was too aggressive in its tightening cycle over 2017 and 2018 and simply needs to bring it back down a little bit. So I think we will see a 25 or 50 pip cut in the next couple of meetings.
Okay, now what traders are certainly taking a look at is our next chart here, probability of a rate cut. And just look at that, straight up.
Yeah, so it really broke out in the end of May, and as you can see, it went from around 25% as of yesterday. Following yesterday's meeting, it's now 100% probability that the Fed is going to cut rate at the July 31st meeting.
See, and that'll be interesting to see what the reaction is, right? Because its expectation is in the market. So you finally get what everyone has been asking for. What happens after that? And I think that's really what the question is. Fine, we get these rate cuts. Well, what does the market do next?
Right, so I think the market does overall look very constructive. The S&P 500 today made a new all-time high, and the other indices are not far behind it. So that's certainly a bullish sign. The breadth of the market is also improving as well. We noted this a couple of weeks ago. The percentage of stocks in the S&P 500 that were making fresh 52-week highs had broken out to almost a 2-year high. So that's something you want to see, the internals of the indices doing well, not just the overall index. All
right, let's take a look at gold on the daily chart. You are looking at a key resistance level here that you've been talking about this for a couple of weeks now. Yeah,
so in the previous chart, we showed that in late May, the probability for a hike really spiked, and accordingly, at the same time, gold had its breakout. It held support around 1275, which has been support since January, and then it broke in late May above the declining resistance line and has since been in an uptrend. Had a brief stall at the prior high made in February around 1345, 1350, and the last couple of days, today and yesterday specifically, following the Fed announcement, it's spiking now higher. But more importantly, I think the big test now coming up for gold is the 1350 to 1395 level, which is currently where we are right now, the upper end of that range. And if you look at the next chart, the monthly chart, we can see why I think it's important.
Let's move that chart along to the monthlies. And over here, you are taking a look at key Fibonacci levels. And that's something that you bring up a lot in the course of our chart talk. Give us a super high level, quick 30 seconds of why traders look at Fibonacci levels. What are those?
Fibonacci levels, they have been around since really the 13th century when a famous mathematician, Leonardo Fibonacci, came up with them. And he just found certain numbers and ratios to be important and to be found throughout the environment, throughout the galaxies, things of that nature. And over time, traders have applied those levels to the stock market on the theory that the forces of nature can also apply to forces of the markets.
And it's not just stocks or ETFs. You use this a lot when you're looking at FX. I mean, you could apply it to any chart.
I find that it works best in instruments and securities that have the most volume, the most price action going on. So the S&P 500, currencies especially, they really seem to shine. And what they end up doing is acting as future levels of resistance or support, depending on which side of the price they are on.
All right, so what are you looking at here?
So here we have gold. This is important. Over the last 4 years, it's been topping out around this 1390 level. It had a 4 or 5 year downtrend from 2011 to 2015 where it lost 45%. And the rallies since then have consistently been peaking right here at 1390.95. It does represent the 38.2% Fibonacci retracement of that downtrend. What I find interesting is that this time we're getting a breakout in the monthly RSI, which is a momentum indicator. It broke above that 58 level this month, and that has been the high since mid-2016.
All right.
So a lot of times momentum can lead price, so the theory there is maybe price now will follow momentum and make new highs as well.
All right, let's wrap it up with our last chart here. Take a look at oil, certainly in the news, especially this week.
Oil's doing well. We highlighted this last week as our chart of the week. We had a potential double bottom last week. Today's price action on the move above 54.85 confirms that. That's the so-called trigger that a lot of momentum investors will use to chase the long side of this trade. The range of the pattern was $4.24, so we come up with our projected move by taking that width and adding it to the top of the range, or the midpoint of the W pattern, which is the double bottom, which projects to about 59.08. That's the minimum measured move, which is up about 3.5%, and certainly could go above there.
See, what's interesting though is part of this move has to do with geopolitics and tensions in Iran, right? I mean, it's not like it was predicated exactly on these levels on the chart. So it's kind of like fundamentals and technicals go hand in hand.
Correct. A lot of times, what the technicals are reflecting is what's going on in the fundamentals, or other things like geopolitical risk, other types of risk.
But you look at levels for entries and exits just to have a better understanding of the price movement. Is that how traders use this?
Absolutely. So what we were highlighting last week is that, and we were concerned last week that maybe this was not going to play out the way a typical double pattern would. We had said it was an early call, but at the very least what it does is it helps you identify risk levels that you could apply to your investment strategy.
Perfect. Thank you so much, Brian. And thank you for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.